Welcome to the Torch Academy. Today, we're breaking down deal structures, cash, SBA loans, earnouts, and seller notes. Many sellers focus only on price. What's the purchase price? But deal structure is just as important. A $2 million deal paid 100% at closing is very different from a $2 million deal paid in 4 installments over 5 years. And the tax implications differ dramatically. Let's break down the main structures you'll see. All cash is rare and awesome. If someone offers all cash, take it seriously. But don't assume it's the best deal. All cash buyers often expect a discount. Most deals are financed. The buyer needs a bank to fund the acquisition. This is normal. The SBA 7A loan is the workhorse of small business financing. The buyer needs to put 10 to 20% down. That is their equity. The bank funds the rest. The SBA guarantees 75% of the loan. That guarantee gives banks the confidence to lend. Here is what that looks like in practice. For a $2 million business, the buyer puts down $200,000 to $400,000. The bank then lends $1.6 to $1.8 million. Closing happens once the bank approves. As a seller, SBA financing is usually good news. It means a wider pool of qualified buyers. But understand the risk. If the bank doesn't approve, you have no deal. So in due diligence, monitor the bank's concerns. If something is worrying the bank, work on it. The better the business looks to the bank, the faster they approve. Seller financing is common when the buyer doesn't have enough down payment, or the bank won't fund the entire amount. You're essentially becoming a lender. There's risk here. If the buyer's business falters, they might not be able to pay you. But it also lets you finance a deal that otherwise wouldn't close, and you earn interest income for a few years. Seller notes are a negotiation tool. If the buyer doesn't have enough capital, offering to finance part of it can close the deal. Just make sure the terms are clear and properly documented. Online promissory note templates handle the standard structures, and if you'd feel more comfortable, an attorney can review or draft them for you. And understand your risk. If the buyer can't pay, you're in a position to either forgive the debt or take control of the business. Earnouts are how buyers reduce risk. They're saying, I'll pay full price, but only if the business performs as you've described. From a seller perspective, earnouts are dangerous. You're betting the buyer will maintain the business and hit targets. But if the new owner makes different strategic choices and revenue drops, you lose earnout money. Minimize earnouts if you can. If a buyer insists on an earnout, negotiate hard on the terms. Make the earnout achievable. If the business is already doing $5 million in revenue and you have stable customers, an earnout based on maintaining that revenue should be easy. Push back on aspirational targets like grow revenue 25%. That's speculative. Most deals don't hit the best case scenario, but you can negotiate for something reasonable. The goal is to get as much cash as possible at closing, minimize seller note if you're uncomfortable with credit risk, and limit earnouts to achievable targets. Online platform tools and standard deal templates can guide you through these negotiations. And if you have an attorney, they can help with the specifics. This is technical tax territory. Different structures have wildly different tax bills. A seller note structured properly can defer taxes over several years. An earnout might be treated as ordinary income or capital gains depending on how it's written. Before you commit to a deal structure, do your homework on the tax implications. Online tax resources can walk you through the basics, and if you want a personalized analysis, a CPA conversation could save you 6 figures. You have leverage during negotiation. You're the one with the business. Buyers come and go. Push for terms that protect you and get you paid quickly. If the buyer won't negotiate on price, negotiate on terms. If the buyer won't negotiate on either, walk away and wait for the next buyer. Deal structure isn't just about price, it's about risk, taxes, and when you get paid. Go into negotiations with a clear view of what works for you and what doesn't. Online platform tools and templates can guide you, and an attorney can help if you're working with one. But the decision is yours. The takeaway: don't fixate on the headline price. A $1 million all-cash deal is very different from a $1,200,000 deal with a $300,000 earnout. Understand the risk profile of each structure. All cash is safest. SBA loans are reliable, seller notes carry risk, and earnouts are bets on the future. Evaluate the total package, not just the number. Thanks for watching. If you found this helpful, head over to torchapp.io/signup and create your free account. Torch uses AI to help you navigate buying or selling a small business. Whether you're just exploring or ready to make a move, we can help. And don't forget to subscribe for more episodes from the Torch Academy.